Mihir Vora of Trust Mutual Fund is joining in on today's show to take this conversation forward. Mihir, good afternoon. And thank you for joining in. It's not the most ideal start you would hope for a March series, which has historically, or at least for the last 2 years, made sure that the market has taken a bit of a pause for the selling and then moved higher. What do you go, where do you go from here now, Mihir? Because every time when you've seen a fall like this, you'd say, okay, it's time to deploy money, it's time to deploy money, at least for a longer term horizon, and then you see the market fall further. What do you do in a scenario like this?
Well, all you can do is, do a couple of things. First of all, ensure that your original thesis is solid and stick to that thesis in terms of what I'm saying is the asset allocation thesis. So as an investor, for traders, life is much tougher, I would say. But as an investor, I think the original thesis, as long as you are convinced about the original thesis of asset allocation, I would stick to it. Second is in terms of risk control, I would maintain the allocations because once you have decided that certain asset classes have certain risk return characteristics and we need to deploy the portfolio accordingly, we need to stick to it. And second is, don't get swayed by volatility. Sometimes people, use the volatility as an excuse to change the broad thesis, which should not be the case because the thesis came first. Volatility was anyway part of the original assumption. So I would say stick to the discipline and broadly, if we have the assumption that India will grow at 16.5% for next year, then I think a lot of the negatives and the downgrades in earnings that we've seen in the markets are in the price. I would say indices, the broad index is down almost 18-19%. The small cap index is down almost 25%. Right. So whatever earnings downgrades have happened are also to a great extent in the price, and we can see that in a lot of the sentiment factors.
You spoke about these sentiment factors as well. I was looking at some of your social media posts, Mihir, and you said that there is extreme fear, extreme pessimism on the street, with only 14% of the stocks actually being above the 200-day moving average in a broader index. And similar is the case for all the other indices that you've been tracking, the small and mid-cap indices as well. We're down a fair bit on the frontline index. And you've also coupled that with a quote from Peter Lynch saying that everyone has the brain to make the money in the stock market. No one has the stomach. In a situation like this, where there is so much fear, are you finding opportunities which are extremely attractive? And what is your, deployment strategy like? Are you putting all your money in that, or maybe just a proportion of the money in the stocks that you're liking, only to protect yourself from further downsides and perhaps average at lower levels if the markets were to fall further?
Certainly. So, first of all, we don't keep too much cash. So, somewhere between 5 to 10% is the cash levels that we keep. Beyond that, we typically do not keep unless we have a very doomsday kind of a view, which we don't at this point in time. Second is, this gut wrenching volatility is also being used to kind of do some spring cleaning in your portfolios. It should be used. So, for example, when you have such a large correction and stocks having fallen by 30, 40, 50%, a lot of them, of course, have become cheaper by 50%, but some of them will not lead the market the next time around. So you probably also need to do a little bit of fine tuning in the portfolio because some of the theses would have changed, some of the assumptions would have changed. So you can use this opportunity in both ways. First of all, buy the same stocks, at cheaper prices, but also decide on the strategic spring cleaning, whether the same, whether some of the leaders of the last rally will continue to be leaders. If not, then probably you want to then realign the portfolio.
As the assumption changed for one of the leaders of the last rally, which was the PSU names, because a lot of these names have corrected anywhere between 40, 50, even 60% from the top. And even then, most of these names are still expensive if you compare them to a 5-year average. Is there a pocket within the PSUs that still attracts you right now, be it railways, defense, shipbuilders? Are you intending to put money anywhere here? Is there a pocket of opportunity that is emerging beyond the PSUs?
Sure. So PSUs, I have never really considered PSUs as one bunch, because you have a coal miner on one side, you have oil marketing companies, then you have utilities, then you have the defense, then you have the railways, then you have the public sector banks. So it's really a big bunch of industries that we need to choose from. So I would really look at it stock by stock. But in general, as of now in the portfolio, we only have exposure to some of the defense names, and that's the only names that we've been liking for a period of time. And we are sticking to that. We don't have any of the PSU rail names or the PSU banks except one. So in the PSUs, we probably are more on the defense side only.
All right. And when you said that, the leaders of the next rally might not be the same as the leaders of the previous rally, do you have any early signs of what do you think is a lot more attractive than what it was, say, 6-7 months ago? And where do you see the next leg of up move coming in from? Is there any sector that particularly calls out to you?
Certainly. So, Mangalam, as you remember, we've been always more bullish on the capital market plays within the financials. So in financials, in general, we were underweight on banks and NBFCs and more overweight on the capital markets. So strategically, we continue to be, positive on the capital market theme. But I think relatively speaking, given the way the circumstances have changed and given the way RBI has now changed its stance, on top of the fact that this segment, the banks, the large banks and the large NBFCs underperformed for almost 2 years, and now makes it a case in terms of valuation as well as growth potential to probably get more bullish on those names compared to what we were 6 months ago. So that's one significant change. We are increasing exposure to the large banks and the large NBFCs in the portfolio because RBI has been now easing on the norms, easing on the the capital requirements on lending to NBFCs, and RBI's cut rates, and plus there is a liquidity infusion which should help the financial sector. So that's one significant change I would say that we see in the next rally.
Even after this, Mihir, when the stocks are down 30-40%, is there a pocket where you would want to still stay away from? Is there something that you say, okay, no, even if it is down 30-40%, I would still not want to touch it because it's still, for whatever reason that may be? Is there a pocket like that?
So we've been consistently underweight on the metals, the global commodities. We've also been consistently underweight on FMCG because we think it's a low growth segment, and we continue with this. We are also consistently underweight on some of the utilities because by nature we are growth investors. We are looking at earnings growth and visibility of earnings growth. So these are segments where we feel they are more cyclical in nature or low growth in nature. So that's where we continue to be underweight. So FMCG, metals, global commodities, including energies, the low growth utilities, as well as the large cap IT are places where we continue to be underweight.
All right, we take that point, Mihir. Thank you so much for joining in, and hopefully, when we next speak, there would be some of this pessimism and fear which would be out of the market, and maybe gentlemen like you and some of your investors would have made money by making the best of this fearful scenario by deploying capital in places where you think there is value and growth opportunities from current levels as well. So that's the fundamental medium to long-term sort of view coming in for the market. What we'll do is take a short break. On the other side, we'll tell you what trading strategies in the very near term could be as well, whether they're on the long side or the short side. Ajit Mishra joins in.